Hi everyone, welcome to today's class. So today we will speak about the FMCG sector. Predominantly, let me start this discussion by talking about two specific data points which are very interesting. The first data point is that almost 90% of the retail segment in India is unorganized, and FMCG is a great proxy for retail. The second key data point comes from the A.T. Kearney report, which says that by 2030, the retail segment would be $1.8 trillion opportunity. So it is no surprise that big FMCG companies are ramping up their business and trying to capture a bigger piece of this pie. So on this video, we will take a look at some key points or the value drivers that drive the FMCG industry, and we will take a look at some of the key developments happening in this industry, and finally we will close out the video by talking about some key guidance for investors on how to invest. So let us get this class started. So let us start understanding the key value drivers of the FMCG industry. And let us start with the most important value driver, which is ROCE, Return on Capital Employed. Now, what exactly is ROCE? Let us pick two examples to understand that point. The first example is of Nestle. The ROCE there is 147%. Similarly, with HUL, Hindustan Unilever, the ROCE is 39%. Now, what does this figure 147%, 39% exactly means? It means this, that if you give Nestle 100 rupees this year, then by next year, it will convert this 100 rupee into 247 rupees. Similarly, if you give HUL 100 rupees, it turns those 100 rupees into 139 rupees. Now, what is the utility of having high ROCE? It is very simple. It allows these companies to become dominant players in the market. For example, take a look at this particular chart. You will see the market dominance of Nestle in the baby formula industry, where it controls almost 96% of the industry. Take a look at this particular chart. It shows HUL controlling almost 55% of the detergent market share. This is a fairly large number for any company, and whenever companies make more than 50% market share, they start dominating that particular market, and it gives them immense marketing and pricing power. So let us try to understand in detail how this pricing game is played out in actuality. A classic case in point would be the 2020 COVID crisis. When 2020 COVID crisis hit, what was the repercussion? The repercussion was that the inflation started climbing up. When quantitative easing takes place, that when the government prints a lot of money, the inflation goes high, and a lot of unorganized market share ends up going to companies like HUL and Nestle. Why is it? Let us try to understand that through a simple example. When inflation goes high, we would still continue to buy shampoos, we would still continue to buy branded detergents, but smaller players who do not have any pricing power, who do not have any power to control their suppliers or ask them to cut cost, the inflation for them becomes a big problem. So from that perspective, whenever inflation number goes up, companies like HUL and Nestle, they benefit a lot. A classic case in point is that when in 2021, the inflation number started to go up, companies like HUL, Nestle, they increased their product prices by approximately 15%. Even in the Feb of 2022, according to some reports, HUL has increased its product prices by 1 to 9%. So as a result, these big companies, big branded companies, they are able to increase their prices and maintain their market dominance, but smaller players go away from the market. And due to this pricing game, these companies keep on increasing their market share and market price. Why are they able to do it? Relate point 1 and point 2. It has to do with ROCE, and we will understand this point next. Now think about this, that when a company like HUL or Nestle has a very high ROCE, what is it that they are doing? They are making more money every passing year because their ROCE keeps on improving. Now, if they are making more money, they can pass on the benefits to their distributors. Who are the distributors? They might be small kirana shops, they might be mega malls, etc., who are stocking HUL or Nestle products. So as a result, these big branded companies have a lot of distribution moat. Moat means competitive advantage. So from that point of view, because companies like HUL and Nestle are making a high operating profit margin and high ROCE, therefore they are able to pass on these benefits to their distributors and keep winning this race. From a psychological point of view and customer narrative point of view, this leads to availability bias. Think about this, that when you go to a mall and if you only see shampoos that are by HUL, what are you going to do? You will have no option but to buy them. So this availability bias leads to something called as competitive advantage for companies like HUL and Nestle. So more availability bias leads to more market share leads to more pricing power, and the cycle continues to repeat. Now let's understand the next key value driver, which is demand prediction. Now this is an evolving concept, and you might have heard that there are companies like Asian Paints whose products are all time available. For example, if you visit a store at your local town and you visit any shop, Asian Paints product will be available. Similarly, when you visit a local departmental store, majority of the times they will again have your favorite brand shampoo. How does this entire game is played out? This again becomes a prominent value driver for FMCG companies. Think about it this way, that big companies like HUL, Asian Paints, Nestle, they have a lot of customer data. They can drill down, build a lot of prediction models and data analysis model, and they can do forecasting and prediction as to what products will sell and how many of these products will sell in a particular geography. As a result of these demand prediction models, they are able to stock their supply in a very efficient manner, and the entire supply chain smoothens out. You might have heard very recently that a lot of companies are getting into 10-minute delivery. This 10-minute delivery game is essentially a build-up to how companies like Asian Paints and HUL have been stocking their products. So these big companies, because of the wide availability of data, are able to generate another competitive moat in terms of creating demand prediction. And this becomes one of the key value drivers in terms of strengthening their business. This brings us to the final value add of FMCG companies, which is around product innovation. Now, customers frequently get bored with any products that they get. They use it up to a point and then they discard and they move towards new products. So these big companies, what they do is that they are experts in terms of demand production. Speaking from my own example, as an ex-management consultant, I used to do something called as human-centered design analysis. What it simply means is that you go and research the customer behavior and now try to guess that what type of companies will have budget to do these HCDs, human-centered design studies. Again, you got the answer right, that these would be companies like Nestle and HUL. They will spend a lot of money in terms of studying the customer behavior, asking them the right set of questions, doing a lot of focus group studies, and then predicting what type of products they can innovate that these customers will continue to buy. So when one of the products goes out of fashion, they move on to the next, and even that product becomes a hit. So essentially, all these value drivers of the industry makes an FMCG company stand out. So in order to become a better investor in the FMCG sector, we need to understand some of the key trends that are playing out. So let me speak about 3 specific trends. The first key trend is that more and more unorganized sector is getting converted into the organized space. Almost 90% of the retail segment in India is unorganized right now. So this presents a huge opportunity for these established FMCG players to come and disrupt the space and capture more of this market share, and this is precisely what these big players are doing. Now, the related push here is from the government itself. There is, for example, 100% FDI in retail right now. Retail is a great proxy for FMCG, so this is shaping up the FMCG space. Another related point is the push towards digital segment. Many companies, for example, Reliance, are completely altering their model and are moving more and more towards digital. And as a result, they are being able to build a competitive advantage in the FMCG segment also. Now comes the second key point, that the established FMCG players are being challenged by niche companies. A classic case in point is Patanjali and Fog, for example, that these companies are challenging established players like HUL, Dabur, etc. in some of their niches. Fog, for example, is challenging in the spray and deodorant market. This is becoming a very good niche player from that category. The third key that is coming up is the rise of small regional players. A classic case in point is Amritanjan, which is a small cap company based in South India, but over time they have expanded their product lines also. For example, they started out with a yellow color balm called as Amritanjan balm, we must have all heard of it, and they have built more and more of their products in the pain relief segment. For example, they have come out with pain patches, and they have come out with pain sprays, etc. They have also taken product line extensions. For example, they are gaining market shares in the sanitary pad space also. So as a result, these small companies are also rising up. These are well-moated companies. They also have decent ROCE, and they are coming up as challengers to big players in certain areas. The best part about these small companies is that they have a lot of rooms to expand. So from that particular viewpoint, before you make investment in any FMCG companies, try to remember these key trends and their internal moat and advantages. So in summary, investors should keep 3 critical points in mind. Number 1, what is the competitive advantage or winning moat of a particular firm? We studied that companies like HUL and Nestle have massive advantage when it comes to ROCE or return on capital employed. They also create winning advantage in undertaking customer research. Second key point that we must remember is the branding power of a particular company, because it helps that company to increase the prices and fight conditions like high inflation, which is currently ongoing in the economy. Third key advantage is the opportunity to expand. This applies to companies like Amritanjan, which are undertaking both geographical expansion and also product line expansion. So if you keep these major points in mind, you will be able to invest intelligently in FMCG space. I hope you enjoyed the class. I will see you the next time.